A bank vault holding $1 million in 1980 and open today would reveal a devastating financial paradox. The stacks of currency remain untouched, yet more than two-thirds of their value has vanished into thin air. This is the silent architecture of wealth confiscation. You are not losing money because of bad investments or market crashes, but because the very measuring stick of wealth is shrinking. The hidden cost of simply holding currency steals financial security right out from under the most disciplined savers. We often mistake inflation for the independent rising of prices at the grocery store or the gas pump. In reality, it is the devaluation of the currency itself. When the supply of money expands faster than the economic output of goods and services, each individual dollar loses a fraction of its purchasing power. This erosion acts as a regressive, invisible tax on liquidity. It silently drains the energy from your capital before you even attempt to deploy it into the market. For the individual investor, this creates a dangerous illusion of prosperity. You might look at a savings account yielding 4% and feel a sense of security. But if the broader economic environment is running at a 6% inflation rate, your actual purchasing power is contracting by 2% every year. You are being taxed on nominal gains while suffering real losses. Understanding the critical difference between nominal numbers and real returns is the foundational step in defending your financial future. The 1970s provide a masterclass in this destructive dynamic. During that decade, a combination of oil embargoes, expansive fiscal policy, and unmoored monetary expectations sent the consumer price index spiraling into double digits. A dollar saved in 1970 lost over half its purchasing power by 1980. Investors who clung to cash or fixed-rate bonds were decimated, their lifelong accumulations hollowed out by an economic force they could neither see nor control. The echoes of that era still dictate how institutional capital moves today. At the center of this macroeconomic battlefield sits the Federal Reserve. Tasked with a dual mandate of maximizing employment and stabilizing prices, central banks wield immense power over the velocity and volume of money. When they adjust the federal funds rate or engage in quantitative tightening, they are directly attempting to engineer the cost of capital. These policy levers dictate whether your money will grow in utility or wither in the shadows of macroeconomic intervention. Traditional safe havens become traps when currency devaluation accelerates. Long-term government bonds, often heralded as the bedrock of conservative portfolios, transform into certificates of guaranteed confiscation during high inflation regimes. If you lock up capital for 10 years at a fixed 3% yield while inflation averages 5%, you are contractually agreeing to become poorer. The safety of principal means nothing if the principal cannot buy what it used to. This tension frequently triggers a yield curve inversion, a financial phenomenon where short-term debt instruments offer higher yields than long-term debt instruments of the same credit risk. When investors demand higher compensation for short-term risk than for long-term risk, it signals profound market pessimism and often precedes an economic recession. Bond markets use this inversion as a distress flare, warning that central bank efforts to choke off inflation might also choke off economic growth. To counter this erosion, capital naturally flows toward hard assets. Real estate has historically served as a formidable fortress against currency debasement. Because property values and rental incomes tend to rise in tandem with broader price levels, real estate effectively absorbs the inflationary shock. The debt used to acquire these assets also depreciates in real terms, meaning you repay fixed-rate mortgages with dollars that are worth progressively less. True wealth preservation requires a relentless focus on real returns. This metric strips away the illusion of nominal growth by subtracting the inflation rate from your investment yield. If your portfolio grows by 8%, but the cost of living jumps by 4%, your real return is only 4%. Every strategic financial decision must be filtered through this uncompromising mathematical reality to ensure your purchasing power is expanding, not just treading water. Modern markets process these inflationary signals with terrifying speed. Algorithmic trading, the use of complex computer programs to execute trades at speeds and volumes impossible for humans, instantly reacts to new consumer price index data. Within milliseconds of an inflation report missing expectations, these algorithms can dump billions of dollars in vulnerable assets and reallocate into inflation-protected sectors. This hyper-accelerated environment means retail investors cannot rely on reactive strategies. They must be proactively positioned. For professionals managing institutional capital, protecting against this erosion is not just a strategy, it is a fiduciary duty. This is the legal and ethical obligation of a financial advisor or asset manager to act solely in the best interest of their client. Failing to account for the destructive force of inflation when constructing a long-term retirement portfolio is a profound breach of this duty. Wealth managers must actively seek out assets that offer a reliable premium over the rate of currency debasement. Equities offer a dynamic defense mechanism provided you select the right companies. Businesses with high pricing power can pass increased underlying costs directly to the consumer without sacrificing demand. Think of essential consumer staples, specialized healthcare providers, or monopolistic technology platforms. These entities act as inflation pass-through vehicles, protecting their profit margins and, by extension, the real wealth of their shareholders. Yet, human psychology often sabotages these logical defenses. The concept of money illusion causes individuals to view their wealth in nominal terms, celebrating a pay raise or a portfolio high water mark without adjusting for the diminished value of the currency. You must train your mind to look past the rising numbers on a brokerage statement and ask what those numbers can actually acquire in the real economy. Breaking free from money illusion is essential for objective financial analysis. The consequences of domestic inflation rarely stay contained within national borders, because the United States dollar serves as the world's primary reserve currency. American monetary policy exports inflation globally. When the Federal Reserve raises rates to combat domestic price surges, it strengthens the dollar against foreign currencies. Emerging markets are then forced to pay more for dollar-denominated debt and essential commodities, triggering a cascade of international economic distress. During acute phases of this global currency stress, alternative assets often experience massive capital inflows. Commodities like energy, agriculture, and industrial metals possess intrinsic utility that cannot be printed by a central bank. Gold, the oldest monetary metal, frequently acts as the ultimate barometer of systemic anxiety. While it produces no yield, its historical role as a store of value makes it a critical counterbalance when fiat currencies are rapidly depreciating. The modern investment landscape has also introduced sustainable investing, an approach that considers environmental, social, and corporate governance criteria to generate long-term competitive financial returns and positive societal impact. However, during inflationary spikes, these strategies face severe stress tests. Capital-intensive green energy projects become vastly more expensive to finance as interest rates rise, forcing investors to weigh their ethical mandates against the urgent need to protect their purchasing power. The long-term fallout from decades of quantitative easing and zero interest rate policies is now apparent. By suppressing the cost of borrowing for so long, central banks encouraged massive debt accumulation across corporate and government sectors. As inflation forces rates back up to historical norms, the cost of servicing this debt explodes. This transition from a low-rate environment to a high-rate reality fundamentally alters the calculus of risk and reward across every asset class. Beyond the market, inflation triggers a silent, unlegislated tax increase known as bracket creep. As your nominal income rises to keep pace with the cost of living, you may be pushed into a higher marginal tax bracket. Even though your real purchasing power has not improved, your tax burden increases. This double penalty accelerates the depletion of your capital, making tax-efficient investment vehicles an absolute necessity in an inflationary environment. Navigating this complex terrain demands a shift from static allocation to dynamic portfolio management. The traditional balanced portfolio of 60% equities and 40% bonds relies on those two assets moving inversely to one another. But persistent inflation can cause both stocks and bonds to sell off simultaneously. Investors must broaden their horizons to include floating rate debt, real assets, and strategic cash reserves that can be deployed when market dislocations create generational buying opportunities. We can uncover valuable lessons by comparing past crises to modern supply chain disruptions. While the 1970s inflation was largely driven by energy shocks and wage price spirals, recent inflationary bursts have been fueled by deglobalization, pandemic-induced logistical bottlenecks, and massive fiscal stimulus. Recognizing the structural differences between these eras allows astute investors to anticipate which sectors will suffer margin compression and which will command premium valuations. Corporate earnings reports become a critical battleground for analyzing these dynamics. Companies that rely heavily on raw materials and labor face intense margin pressure as input costs soar. Conversely, asset-light businesses with recurring revenue models often demonstrate remarkable resilience. The ability to dissect an income statement and identify a company's vulnerability to input cost inflation separates successful capital allocators from those merely riding market momentum. You must conduct a ruthless audit of your own financial exposure. Assess the duration of your fixed income investments, evaluate the pricing power of the equities you hold, and calculate your personal inflation rate based on your specific consumption habits. Your cost of living may rise significantly faster or slower than the official headline numbers. Tailoring your defensive strategies to your actual economic reality is the only way to ensure your wealth survives. One specialized tool for this defense includes Treasury inflation-protected securities. These government bonds are uniquely structured so that their principal value adjusts upward with the consumer price index. While they may not offer the explosive growth of technology stocks, they provide a mathematically guaranteed defense against the erosion of purchasing power. Integrating these instruments into the conservative wing of a portfolio provides a stable foundation when macroeconomic volatility spikes. Looking toward the horizon, structural forces suggest that elevated inflation may not be a transitory anomaly, but a persistent feature of the new global economy. The aging of the global workforce reduces labor supply, driving up wages. Simultaneously, the geopolitical push to reshore manufacturing away from cheap overseas hubs increases production costs. These seismic demographic and geopolitical shifts create an underlying inflationary current that will define the next decade of capital markets. The erosion of purchasing power is not an unstoppable force of nature, but a predictable economic mechanism that can be managed, mitigated, and even leveraged. By rejecting the illusion of nominal numbers and demanding real returns, you transform your approach to wealth accumulation. Armed with a deep understanding of macroeconomic policy, asset pricing power, and market history, you can build a financial fortress that withstands the silent theft of inflation and secures enduring prosperity.